One of the most trusted names in Canada's mortgage and financial industry is sending a clear message on where the Canadian economy stands, and it's not good. In today's video, I'm going to break down recent comments from Benjamin Tal, the Deputy Chief Economist at CIBC, and what this means for average Canadian homeowners and anyone watching the real estate market right now. If you're not familiar with Benjamin Tal, he is one of the most respected economists in the country, someone the mortgage and banking industry listens to very closely. He's been analyzing housing, lending, and broader economic trends for decades. His insights shape how banks price mortgages, how governments design housing policy, and how investors interpret what's happening in the market. So when he stands up at a national mortgage conference and says Canada is already in a recession, people pay attention. At the Mortgage Professional Canada's national conference in Ottawa, Tal explained that while Canada might not officially meet the 2 quarters of negative growth definition yet, on a per-person basis, we're already in a recession. Population growth is making the top-line GDP look better than it really is. But when you divide that growth across millions of new people, it becomes clear Canadians are producing and spending less than before. He described it as the biggest test to the mortgage and real estate industry since the 1990s, pointing to weak consumer spending, rising unemployment, and a housing market that has effectively frozen in some regions. According to Tal, what we're going through now is the painful process of normalizing the abnormal. For years, ultra-low interest rates, record population growth, and global trade distortions created an economy that wasn't sustainable, and now we're feeling the adjustment. He pointed to trade tensions, particularly U.S. tariffs, as a big reason inflation stayed higher for longer. In his view, those tariffs act like a hidden tax on consumers, raising prices on almost everything, and they're not going away anytime soon. Now, here's where his comments really matter. For anyone with a mortgage, Tal believes inflation has already come back under control and that the Bank of Canada is now being too restrictive. He thinks the bank has the green light to start cutting rates, and soon. His forecast calls for a quarter-point rate cut at the next few meetings, with another one possible in early 2026. CIBC expects the bank's overnight rate to eventually settle around 2.25%, where it could stay through the end of 2026. That is good news for borrowers, but he also warned there's risks if rate cuts are delayed. Roughly 10% of households could see their mortgage payments rise by 50% or more at renewal if rates stay where they are. On housing, Tal says the market right now is frozen. Homes are too expensive to buy, yet not expensive enough to build, which is a terrible combination for supply. He noted that construction has slowed sharply, especially in Ontario and BC, and the condo market in particular is in a downturn. Prices have fallen 20 to 22%, and he thinks that they could still drop by another 5 to 10% before stabilizing. Low-rise homes are holding up a bit better, but pre-construction activity has cooled across the board as developers face high costs and tighter financing. Tal also said government policy could make a difference. He's been pushing for Ottawa to expand the GST-HST rebate on homes beyond just first-time buyers. In his view, if you want to improve affordability, make the incentive available to everyone, not just a select group. Another major theme Tal touched on is population data, and this one surprised a lot of people in the room. He believes Stats Canada is undercounting the population by close to 1 million people because it assumes many non-permanent residents have left the country, when in reality, most have stayed. That undercounting causes governments and cities to plan for too little housing and infrastructure, which keeps the shortage going year after year. He also supports the idea of converting people already working or studying in Canada to permanent residents, saying these newcomers integrate faster and tend to buy homes within 2 to 3 years instead of 5 or more. Tal wrapped up on a cautiously optimistic note. He called this period the biggest test in Canada since 1991, but we're getting close to the bottom. In his outlook, a combination of lower rates, targeted federal spending, and eventual trade stability should help lift the economy in 2026 and 2027. So, according to Benjamin Tal, Canada is already in a recession, at least on a per-person basis, but the good news is that we may be nearing the turning point. Thanks for checking out this video. If you enjoyed this one, you're going to love this one as well.